Thank you very much. It's a great pleasure to be here today. I was looking around. I said as I kind of looking around as you all were talking beforehand that there are probably a ton of realtors and lenders out there who are saying, where is that appraisal? Where is that appraisal? We can't close until we get that appraiser. And none of them are getting done today, right? Because we're all here. So thanks for inviting me. I always enjoy it. And this is the time that we talk about the housing forecast. I trust you all got copies of the publication out there, and I just have to give a big thank you to Security First and to Meritrust Home Loans for making these publications available. So please, there are lots and lots of copies there in the main lobby, and you're welcome to take as many as you need for your purposes. We had a lot of fun with the theme this year with the kind of historic photos and the Sanborn maps. If you look actually at each of the different publications. So we do forecasts for Lawrence, Kansas City, Topeka, Manhattan, and Wichita, but also we do some smaller publications for 22 counties across the state. And in every individual publication, the map that's on it is local to that particular city. And so we had a lot of fun with that, and then some of the photos that are in here. I also always try and make sure that I give thanks to the Realtors Association, both the Realtors of South Central Kansas, which have been friends of the real estate program at Wichita State since its founding back in the late 1970s, but also the partnership that we have with the Kansas Association of Realtors, which gives us access to the data to make it possible for us to do this forecast. So I just want to give a big thanks to them. And with that, we can talk about what is happening in housing markets across the state. The Center for Economic Development and Business Research, back at the beginning of October, released their annual forecast for employment for Kansas and for the city of Wichita. And the short summary of that forecast is that we've had really strong employment growth for Wichita here over the past year and a half or so. More than 1% growth per year, which is much stronger than what we've seen recently. They're forecasting that to slow down to about 0.5% employment growth, which is more consistent with where we've been over the course of this recovery. But still, that's reasonably solid employment growth. The big thing that's holding back employment growth, both in the state as a whole and especially in Wichita, is the available labor force. We just don't have enough bodies available to fill the jobs and the opportunities that we have. Now, some of the employment growth, we've seen actually very strong employment growth in the manufacturing sector, and a lot of that has actually been satisfied by new entrants to the labor force. Perhaps people who retired or just gave up at some point in time have come back into the labor force. A small amount of that, maybe people moving back in the Wichita area. But we could see that in many, many other sectors across the economy to have much stronger employment growth if we could just bring more people into the labor force. And of course, that ties then with the unemployment rates that we've seen, which the unemployment rates are essentially at historic lows here in the Wichita area and across the country. And so the short summary of the labor market situation for the housing markets is that people who want jobs are finding jobs. We're seeing some reasonably healthy wage growth. There's competition for workers. The only thing that's a negative from the housing market is that we'd love to see more people moving into the community to take the other jobs that are available. So it's a very solid employment outlook that we have. Similarly, the mortgage markets are incredibly favorable for housing markets right now. If you heard me talk a year ago about mortgage rates, I said we were on that track where mortgage rates were beginning to tick up. And we've been sitting here for so long saying mortgage rates have to increase. They've got to increase. And last year I said, this is the year when mortgage rates will finally go up. And as you can see there, just as soon as I said that, it's just almost exactly after we released the forecast, mortgage rates began to fall and have dropped now more than a full percentage point from where they were a year ago. You'll also notice on this chart that the Mortgage Bankers Association has thrown in the towel as well. Their forecast for the 30-year fixed mortgage rate is for rates to stay below 4% not through the end of next year, but through the end of 2021. And if you actually look at their long-range forecast, it's through the end of 2022 as well. So essentially, they see nothing that is going to move a significant uptick in mortgage rates for the foreseeable future. I still personally believe, and I think most economists believe, that this interest rate environment that we're in, really worldwide, is not a sustainable, normal interest rate environment. But that being said, it could stay here for a long period of time. I mean, if I think of what normal mortgage rates ought to be, if you just think about it, if you want me to lend money to you, I ought to get enough money to be a reasonable, real rate of return on my money, just for deferring my consumption. That ought to be about the real growth rate of the economy. Let's call that 2.5%. I have to get compensated for loss in purchasing power, inflation. Let's call that 2%. Then now I'm up to 4.5%. Plus I ought to get a little bit of return for the risk that I have for that relative to, say, one-year Treasury securities, which is the least risky security there is. I'm talking a 30-year mortgage here. So let's add another 1.5% there. Okay? So you add all those up, you ought to get up to pretty close to 6%. I really think 5.5% to 7.5% is a range of mortgage rates that would be consistent with healthy economy, stable financial markets, and low inflation. What we're seeing right now is interest rates that are below that level, and I think it really is reflective of the fact that financial markets are still in a weird place relative to, as a wake of the fallout of the financial crisis. We've never actually fully normalized. We've fully recovered, but we've never fully normalized again following the financial crisis. I would also say what in particular drove these long-term interest rates down was the 10-year Treasury, because that's the benchmark for 30-year fixed mortgage rates. And that's being driven down by lower growth rates and negative nominal interest rates in other parts of the world. And so investors and participants in the financial system that have to be a part of the financial system, they can't take their money and put it somewhere else. U.S. Treasury securities have been the only place they can go, and that's been driving down 10-year Treasury rates, which is what's been driving down these mortgage rates as well. So again, it's extraordinary situations worldwide. But from a housing market perspective, this is not a bad place to be, right? Money is cheap. And in addition to money being cheap, it's widely available. I don't think we're anywhere near, especially nationwide, we're nowhere near seeing some of the strange things that we saw prior to the onset of the housing crisis. But we are seeing down payment requirements getting lower. We are seeing minimum credit score requirements getting lower. That essentially it's much easier for borrowers to qualify for financing today than it was even just a couple of years ago. And so again, that's a very favorable situation for home sales transactions and for the housing market. And so with that, the current fundamentals are really, really solid. The labor market is solid. Mortgage markets mortgage financing is widely available and very inexpensive. The one caveat that I want to give is that all of this could change in a moment's notice. And that's always true, but somehow it feels more true right now than in other times, is that something could happen. You're driving down the road and a Mack truck T-bones you going down the street, and all of a sudden your world is a different world, right? It feels somehow like everything is really, really favorable for housing markets right now. But if something happens, all bets are off in terms of what we forecast and what we've done. Now, before I go on, I just have to make a comment about that photo. Anybody know where that person comes from? Probably can't see quite so close. It's actually on the economic overview page in your booklets there. That is a worker at Cessna Aircraft in 1943 or 44, I think. So it's during World War II. And she is putting on her lipstick up against a piece of sheet metal there in the factory. So I just think that's one of the coolest pictures that we found in all of this, and really kind of captures the employment side of things and some of the history. And so I just thought that was a really neat picture. So I hope you enjoyed it too. So with that being said, what has been happening with our housing markets? You all know, this is nothing surprising. These are the sales from the South Central Kansas Multiple Listing Service. The maroon bars are the actual home sales every single month. And then I did a moving average. So just looked at the past 12 months, what's the average sales over the past 12 months, to give some sense of the underlying trends that we have here. And what you'll notice is starting in late 2010, early 2011, we began that upward track in home sales activity, and pretty healthy, steady growth up until about the last year to year and a half, when we really seem to have plateaued and home sales are not increasing anymore. Now, I will say this last month, I think, was a pretty good month in terms of home sales, and we're just right on par with where we were last year. But it's been really challenging. Now, this seems strange, right? We have really good fundamentals. The labor market is really solid. Financing is widely available and inexpensive. So why aren't home sales activity taking off? You all know the answer. It's inventories. It's not a lack of demand, it's a lack of supply. And so I'll show more about that in a moment. Our forecast going forward is essentially more of the same. This is actually the same forecast that you'll see across the board in terms of this year's housing forecast. Is what you saw last year is really what we're predicting for next year as well. The very slight decline in home sales activity, it could be a slight increase. I mean, those are really tiny changes. But essentially, we would see much stronger home sales activity if only the inventory was available, especially at the right price points. And so what have we seen in terms of inventories? Well, you all know, sorry, I have a different slide here, so let me kind of mention what I have here. I thought it might be interesting to look at the number of new listings added to the MLS compared to the number of sales out of the MLS every single month going back for the last several years. And what you can see is that from up at a level back in 2011 where there were essentially 2 new listings for every sale, we're now down at a place where we are at about 1.3 new listings for every sale. And so that steady decline is really just a picture of how, as we've been selling homes, we haven't been replenishing the inventory at a rate fast enough to make up for what's come off the market. And so that's what leads to these month supply numbers. And again, month supply is simply a measure of the balance in the housing market. So we take the number of active listings divided by the average pace of sales over the past year. And for Wichita, entire South Central Kansas MLS, that number is just a little bit over a 2-month supply right now. It's the tightest inventory in the state. It's really tight inventories. But even nationwide, where sometimes you'll see some national media that talks about how housing markets are starting to show bigger inventories, you're still only at about a 4-month supply, which is the bottom end of what we normally think of as a balanced market. So overall, very tight markets. But as you all know, there's a big difference depending on what segment. And I picked some arbitrary price points. First of all, price is not the only way you can segment the market. You can segment it based on neighborhood or vintage of homes or a variety of different measures. But with these arbitrary price points, you'll notice that the tightest inventories are at that lower middle price point, $100,000 to $250,000, where we're actually down a little over 1.5 months supply. Incredibly tight at those most popular price points. You go up to the $250,000 to $500,000 price point, and even there, it's still a relatively balanced market. But you get above the $500,000 range, and it's an entirely different world. You have very, very flush inventories. Month supply up around a 10-month supply. And so again, this is not anything new to this audience. You all know that you have to know your market and you have to be paying attention to that. The reason I try and emphasize it is because so often people who come and they look at the materials that I have are consumers in the market, and they need to understand, if I'm a seller, whether or not the market averages really apply to my house depends on where I am compared to those market averages. So, no questions about any of these. Comments? Okay. No one's ever surprised by these things. So, no big surprise. We've seen tight inventories, strong demand. That should lead to some healthy home price appreciation. With this 2014 is the point at which home prices in the Wichita area really began to appreciate again following the fallout from the financial crisis. And this chart is a little bit strange, so let me explain it, make sure it's all clear. What I did is I started at that point, the first quarter of 2014, and I said, let's let that be our baseline. Every other number on this chart is home prices relative to where they were at that initial point. And so you can see that the U.S. as a whole is now up to a point of about 134, meaning that total home price appreciation nationwide on average has been about 34% over that past, 5-year time period. In contrast, for Wichita, we're only up to about 125, just a little bit lower, just a little bit below 125, so 25% total price appreciation. That's actually very healthy, solid, strong appreciation for the Wichita market. So our forecast is actually for continued appreciation. Now, when we ran the numbers, we got this really, really strong number for 2019. I won't be surprised if we're a little bit below that, but any number above 5% is really strong appreciation for Wichita, and we project that that will happen because of the tight inventories that we have this year on year-over-year price appreciation. Next year, that's not a sustainable number of the 7.1%, but the 4.3% next year, that's a really, again, solid, healthy, strong price appreciation number. So we continue to expect to see that.
How is the appreciation calculated?
Yeah, so that's a great question. This number is forecasted based off of the Federal Housing Finance Agency's home price index for Wichita. And there's actually several that they have. This is the all transactions index that they use. Same number that was on the previous chart. That is calculated by a methodology called a repeat sales methodology. So it looks at homes that have sold more than once over, going back data all the way back to the early 1980s. Every time a home sells, if it sells again and its mortgage goes through Fannie Mae and Freddie Mac, that's the restriction of these data, is it only includes mortgages that have been sold to Fannie and Freddie. It could also include a home that refinanced and had an appraisal. So your appraised values would show up as the values here if that loan was ultimately sold to Fannie and Freddie. Every repeat sale, they then say, well, this is exactly the same house. So they try and throw out instances where there's been a significant change to the property. Okay, so if there was an addition done or something like that, those get excluded. But if it's the same house that sold today and sold 5 years ago, then the price change that we've seen is a measure of underlying home price appreciation in the market over that 5-year period of time. When you have a whole bunch of these sales that happen at different points in time, the repeat sales methodology is essentially a regression technique that allows you to assign all the information from all of those repeat sales to each different quarter and say how much was appreciation in all those periods of time. Now, the thing that I do have to say about this methodology is that if I go back to this number right here, I didn't show this in a year-over-year percentage change or a quarterly change format. But this index is subject to very big revisions from the initial reported numbers. This is that index, the Federal Housing Finance Agency's index, comparing the index value today, each quarter with the value it was a year previously, and the percentage change. And the thing that I wanted to emphasize, so you can see here that Wichita, we've been bouncing around on a quarterly basis above and below that 4%, with that most recent one, and that most recent one's what's really driving that 7% increase for the year. That most recent increase was up at almost a little over 6% for that year-over-year change. Here's the thing to understand. The most recent data we have is second quarter of 2019. That is based on homes that sold in the second quarter, and then they sold at some point. The first sale was some point long ago in the past. Could have been a year ago, could have been 30 years ago. When we get the third quarter data in, homes that sold in the third quarter will have spanned the second quarter as well, right? It's unlikely that somebody bought the home in the second quarter and sold it in the third. Very unlikely. So somebody who bought a home in August of 2019, and that home previously sold maybe back in 2012, that sale gives us information about home price appreciation every single quarter from 2012 through the third quarter of 2019. The one that it's going to give the most information or the most added information about is going to be the second quarter, because we only had a limited number of observations to do that. The point here is that this price index settles out after about 3 or 4 quarters. Technically, this sale could change the number from 20 years ago, but the amount of information it gives relative to everything we already had is tiny. The amount of information that the new sales this quarter will give relative to what we had last quarter is going to be a lot. Okay? And so this price index does get revised. Was that a lot more information than you really wanted? So the first answer to this question is, this is based off of that repeat sales index. And the advantage of that is that it really is a same home, apples to apples comparison of home price appreciation. That's the advantage of this index and this measure. Any other questions? Yeah.
Have you segmented that by pricing point to see if homes in your $500,000 and higher are appreciating at a greater or lower rate than those below that threshold?
So the methodology here is exactly the same methodology as is used with the Case-Shiller price index that you'll see reported in the national news. Matter of fact, it was Case and Shiller were the two who kind of created this idea back 20, 30 years ago for developing this technique, and then they sold the concept to Standard & Poor's, I think, to be able to monetize that. But the methodology is exactly the same. Standard & Poor's does report some tiered price indexes. I've never been fully convinced by the methodology with the tiered price indices. And here's the challenge, is that those price points move, right? So if a home is bought, my parents sold their house a couple of years ago. They'd been in it for 40 years. I think they bought it for some $30-some-odd thousand back in 1969, and then they sold it for $260-some-odd thousand here a couple years ago. Where do I put that in terms of that price point, and how do I use that to measure that? I've never had full confidence in the methodologies and the techniques that are used there. For small, another way you could do it is what's actually called an hedonic price index. And that is where instead of using repeat sales, you just use individual sales. And it's essentially just exactly what you do if you use regression analysis in any of your work. And the index ultimately is the coefficient on the time variable. Okay? And at that point, you could, in theory, do some splines to be able to separate out those different tiers over a shorter period, and then it's more meaningful. I've not done that here in the Wichita market. But I don't think there's any question at all that there's very big differences across different price points. The other thing to recognize is that because this index is based only off of homes that are sold to Fannie Mae and Freddie Mac, there are two big groups of homes that are omitted from this index in the Wichita market. One would be homes that are purchased by investors. So a lot of that lower end of the market may not be captured very much. Homes below $100,000 or $120,000, investors buying, doing rentals and those things. They're often not selling those loans to Fannie and Freddie, and therefore those aren't showing up. The second is the jumbo market. Now, that's the very high-end homes in this market, but you can see from our inventory numbers that we had, those high-end homes have much more flush inventory, so we would expect that to be very different and not be captured in this. If it was captured here, our averages might be different. So. Well, the other number that we forecast is new home construction, and as you can see, that's just flat. You would think that if we had strong demand, labor market strong, financing is available and cheap, buyers want to buy, there's no inventory out there, prices are appreciating, you would think home builders would be going, woohoo, let's jump out, let's go build a lot of homes. But the problem is that through all of those years, you can see 2010, 11, 12, 13, home prices in the Wichita area declined just ever so slightly on average. Construction costs did not decline during those years. They continued to go up. And even in these more recent years, generally speaking, construction costs have been appreciating at a faster pace than existing home prices. And so as a result, we're in a situation that in those, go back to those inventory graphs here, at those mid-price points, $100,000 to $500,000 where the inventories are, especially between $100,000 and $250,000 where demand is strongest, you can't really build a $250,000 home in the Wichita market that competes with what is the limited inventory available at that price point. And so as a result, most of the new home construction is really at the upper end of the market, and those are often buyers who want what they want, they've got the money, and they're just going to pay for it. But as we were talking beforehand here, one of the challenges that they face is if somebody wants to sell it then a couple of years later, the house is not worth what it costs to construct. And that's a real dilemma. Over the past month, I've done a lot of presentations around some of the smaller parts of the state. And a question I always get when I go out to Pittsburgh or I go out to Hayes or Dodge City or places like that, is they're saying, how can we deal with our housing shortage that we have? And they've been in this place where the cost of constructing a house, even a very modest house, is much more than what that house is worth on the resale market. In some ways, what we are facing here now in Wichita, but it's not just Wichita, it's true in Lawrence and Topeka and Kansas City as well, is that at that really most desirable price point, the cost of construction is still too high relative to where existing home prices are. And as an economist, I say we're in a situation where the supply and demand curves aren't crossing. It just costs too much to produce. So as a result, our forecast is, again, more of the same. We're just bouncing around that 1,000 single-family permits per year. And until we see something that fixes this disconnect between the cost of construction and existing home prices, I don't see how that's going to change. Comments? Questions? Yeah.
Do you think it's the price of construction going up, a combination of all the natural disasters we've been having recently, wildfires, hurricanes?
In one level you would say that, right? So we sometimes thought that there were spikes because of, a hurricane that came through. But, it seems like every single year we've got another natural disaster. We really have to just kind of build in, this is the There is going to be a norm that somewhere there's going to be an extreme demand for the commodities that are associated with the home building process. And we should not expect that somehow, if only we get away from a natural disaster, that those costs are going to drop significantly. The other piece of it is labor. Labor costs continue to go up and continue to be strong. And we lost a lot of contractors during the financial crisis that have never come back. And again, just like every other place, they would hire more if they could find the bodies.
And then, yeah, that's just a cause of lack of skilled labor.
Yeah, yeah. And that's true across the board. Yeah.
What about just the fact that the type of home buyers have changed and everyone wants to rent now? I mean, in Wichita, there's been an explosion of duplexes, and most of the home builders have just like, I'm just gonna build my own duplexes and keep them and just.
And keep them and hold them, right. So question is about changing expectations of home buyers, households. Certainly that has been an impact. One of the things that when I go around and as I prepare for the forecast, I do these real estate roundtables. A few of you have participated in those in the past. And I talk with realtors and other industry professionals about what they're seeing. And a question that I've asked is, are buyers, we're in what, by all rights we have to call a seller's market in the meat of the market. Are buyers acting like it's a seller's market? And on one level, they're bidding for things. But one of the behaviors that a buyer would have in a seller's market is that they would go and purchase homes that they might otherwise not have wanted. They'll buy the home that maybe isn't in pristine condition, that needs some TLC, but has good bones. Or they'll buy a home maybe in a neighborhood that wasn't the neighborhood that they wanted. And the response that realtors mostly, a little bit of an exception in Kansas City, but mostly across the state, they've said is no, buyers still, they want what they want, and if they can't find what they want, they just won't buy. And so as a result, we do see also this dichotomy, even in those price points, of homes that are in kind of, HGTV ready mode versus homes that aren't. And there are homes that have been sitting there for a long time in the MLS because they're either not priced right, realistically, or they're just not ready and not comparable. And it's shocking to me, because my parents were this way, we went this way. It's the idea of, I want a home where I can build some sweat equity. And that is not the mentality that you see much anymore. And it's across all generations.
The millennials, I mean, is it wanting it now?
I think some of it is actually less of, I don't want to impugn millennials in that way, because I don't think it's just that generation. I think it's across the board. In some ways, you could blame the parents of millennials for not teaching the skills of home maintenance and doing things. And so I've got, I'll show you afterwards, I'll show you the picture of my 82-year-old father up on top of the porcherie on my house, rebuilding some of the railings and things that we're reworking to try and get ready for some roofers. And that kind of modeling doesn't always happen anymore. My dad's an amazing guy. So, but that sense of I can do it myself and I'm going to put this work into it. Some of it is dual income households, right? If you don't have somebody at home dealing with things, then you got to hire things in. It's just you don't have the time and the margin in your lives. Some of it is an expectation. I've always been surprised HGTV doesn't inspire people to say, hey, I could do that. Let's go get a sledgehammer and knock out our wall and see if that's a load-bearing wall, right? But it's done the opposite. It's kind of created that perception that if it's not done in 30 minutes, then it's not worth it. So I think those are challenges. Complicated lives, you can rent awful nice things. So it certainly has changed. We've seen a decline in home ownership, but not nearly the decline. Look, it's not nearly the declines that somehow say, wow, the world is ending or anything like that. Other questions? Well, this is our forecast. Again, it's really just more of the same. It's in some ways the easiest forecast. You all could have made the same forecast, and there wasn't anything very too surprising about this at all. We do have copies of forecasts for all the different markets. This is our Kansas forecast, and then we have forecasts for all of the markets across the state. Those are all available on our website at wichita.edu/real estate. And I also want to make a special push here. You'll notice that I was recording the presentation here today. I've taken to trying, I'll just bring my camera. If I get good footage, I'll put it up on our YouTube channel. If I don't, nothing lost. But I'd want to encourage you to subscribe to our YouTube channel. It's WSU Real Estate. Everything we have, anything there, WSU Real Estate should get you to us. And I'm not very far away from having enough subscribers that I can actually get a channel name on YouTube. So if you'll subscribe and help us towards that, we'd appreciate it. And that's what I have for today. So, yeah.
You don't really see anything in the foreseeable future that's gonna help with the supply problem.
So now I'm going to get really into speculation here, okay? But the question was, are you seeing anything in the future that will help with the supply problem? And my answer is no. I don't think there's anything that's going to happen that's going to significantly reduce construction costs, right? Another piece that we didn't talk about here, but building codes and regulations also increase construction costs. And all those pressures are only to continue to increase all of those elements. So I don't see construction costs coming down or even its rate of appreciation slowing meaningful in the foreseeable future. So now my speculation piece is, are we just spoiled on incredibly cheap housing here in Wichita? And are we in a situation where for us to have some meaningful rebalancing in the market, we have to ratchet up our expectations to say that, every home ought to be worth 20, 30% more than it is, to be able to balance that out? I'm not saying I think that's true. I've just begun to ask that question. And of course, the only way that'll not happen is if all of you don't just say all of a sudden every home's worth 20% more. No, yeah, Fred.
Since you looked at all the data across the state, would you just comment on the activity in Kansas City, Topeka, Lawrence, and Wichita markets as to how they compare?
The short answer is, so how do all the other markets across the state compare? For the most part, they look very, very similar to Wichita, with the big exception being Manhattan. Manhattan, over the last few years, has been very counter-cyclical. You'll notice that their home price appreciation this year is actually a little stronger. I don't have they've actually seen home price appreciation that's been much slower than other parts of the state. This is only kind of a just beginning to pick up from zero that they've had here over the past few years for Manhattan. Their inventories are much more flush in Manhattan than they have been in other parts of the state. And their home sales have been increasing. Notice they've got much stronger home sales increase in home sales activity because of the stronger inventories. Part of that is their home prices are much higher. On average, their median sale price is the highest in the state. But that's the one exception. Kansas City, really strong home sales activity. Really strong home price appreciation, and they too are really, really struggling from these inventory issues up there. So very similar.
Just with Manhattan, is that still a fallout from the big red one from 8 years ago in Junction City, just messing everything up?
Not entirely. I thought that was the case. So the question is that really just a fallout of Big Red 1, because you got Junction City that's a part of that metro area. Certainly they've got, in some sense, there's not as much inventory out there in terms of homes as there is, are the townhomes, but also vacant lots. Their big issue is on the development side. They got tons and tons of lots that are out there available to build on that nobody wants to build on, right? So that's the issue that you've got there. But they actually see, their inventories are more flush across the board, and their home sales activity is stronger across the board in all price points. It's true in Manhattan, not just in Junction City. Other questions? well, this would seem like a really good time to break for lunch. So thank you all very much.